If you've never invested before, I want you to know something important. You're not behind, not even close. You're about to learn something that will matter for the rest of your financial life, every single year, for decades to come. And I promise you, this is going to be simpler than anything you've ever read online about investing. Let's start with just $1,000 and build your entire investing foundation from scratch. Here's the truth about Wall Street. The investing industry is deliberately confusing. They want you to feel lost, so you pay them to figure it out for you. Complicated jargon, hundreds of products, conflicting advice from every single direction. It paralyzes beginners. It freezes you completely. But here's what nobody tells you. Investing, done simply, is actually one of the most boring activities in the world. And that is exactly why it works. The boring approach wins, not the exciting stock picks, not the crypto gambles. Boring, consistent, simple investing is what builds real, lasting wealth. And once you understand this, once you truly get it, everything changes. You stop feeling scared. You start feeling confident. Let's build that confidence right now, starting with the most powerful force in all of finance. The single most important concept in all of investing is compound interest. Albert Einstein himself reportedly called it the eighth wonder of the world. Here's exactly how powerful it is. If you invest $1,000 and it grows at 10% per year, watch carefully what happens to your money over time. After just 10 years, that original $1,000 becomes $2,594. You didn't add a single extra dollar. Your money simply multiplied itself. After 20 years, it grows to $6,727. The growth is accelerating now. The snowball is getting bigger, and it's moving faster down the hill. And after 30 years, that original $1,000 becomes $17,449. Let that sink in. You never added another penny, yet your money grew more than 17 times over. That is the magic of compound interest. You didn't add a single dollar, yet your money grew 17 times. Not because you were lucky, not because you were a genius, because of time and consistency. If this just blew your mind, hit the like button and share this with someone who needs to see it. This one concept can change their entire future. But before you invest a single penny, you need to check two boxes. First, you must have absolutely no high interest debt. Second, you need at least $1,000 in emergency savings. These two are non-negotiable. Think about it this way. Investing while carrying 20% credit card debt is like pouring water into a bucket with a giant hole in the bottom. You fill it, it leaks out. You fill it, it leaks out. You're working against yourself. Fix the hole first. Pay off that high interest debt. Build your emergency fund. Then, and only then, start investing. Your future returns will thank you for it. Step 1. Choose the right account type. This matters more than you think because the right account saves you thousands in taxes over your lifetime. If you're in the United States, open a Roth IRA. You get tax-free growth and you withdraw tax-free at retirement. Fidelity, Vanguard, or Schwab all offer these completely free, zero cost to open. If you're in the United Kingdom, open a stocks and shares ISA, tax-free growth plus tax-free withdrawals. Vanguard, UK, or Hargreaves Lansdowne. Both are excellent, trusted places to start your journey. In Australia, check your superannuation investment options first. Make sure your super is actually invested in growth assets, not just sitting in cash. For Germany and France, open a depot account. In Germany, it's called a Wertpapierdepot, Trade Republic, or Scalable Capital. Both are low-cost platforms that make this incredibly simple to start. And if you're in Brazil, open a Conta na Corretora, XP Investimentos, or Clear. Both give you access to the global markets you need. Every country has a path. Just pick yours and open the account. Now I know what you might be thinking. Which one is best for me? Here's the beautiful part. It doesn't matter which specific provider you choose, as long as you choose one. The account is just the container. the vehicle. What actually matters is that you open it this week, not next month, not next year, this week, because every day you wait is a day your money isn't working for you. Pick your country, pick your account, and open it today if possible. Step 2, choose what to buy. And for 90% of people watching this right now, one single investment is enough to get started. That investment is a broad market index fund, one fund that holds thousands of companies across the entire world. You get instant diversification without having to pick a single stock yourself. Here are your options by country. In the USA, look at VTI, the Vanguard Total Market ETF, or VOO, the S&P 500 fund. In the UK, VWRL, the Vanguard FTSE All World Fund. In Europe broadly, IWDA, the iShares World ETF. In Australia, VGS or VDHG. These single funds hold thousands of companies: Apple, Microsoft, companies you've heard of, and thousands you haven't, all working to grow your wealth while you sleep. You don't need to research individual companies. You don't need to read financial reports. You just buy the entire market in one click. That's instant diversification, one fund, thousands of companies, global exposure, all managed for you automatically for a tiny fraction of a percent in fees. This is how you invest without stress, without guesswork, without spending your weekends analyzing stocks. Step 3, dollar cost averaging. This sounds complicated, but it's the simplest strategy in the world, and it's how you remove emotion from investing completely. Do not invest your $1,000 all at once, waiting for the so-called right time. There is no right time. The market goes up, the market goes down. Trying to guess which day is best is a losing game you cannot win. Instead, invest a fixed amount every single month, regardless of market conditions. Here's why this wins. $100 per month, automatically invested, beats $1,200 invested once per year in almost every historical scenario. Why? Because when prices drop, your automatic investment buys more shares. When prices rise, you already own those shares. You buy more when it's cheap without even thinking about it. Set up the automatic transfer, same day, same amount, every month. Then stop thinking about it. Let the system do the hard work for you. This is where most people go wrong. They try to be clever. They try to time the market. They wait for a crash that might not come for years. Meanwhile, the person who just set up automatic investing is quietly buying more and more shares, month after month, building real wealth while the timer waits on the sidelines. Be the automatic investor, not the timer. The data is overwhelmingly clear on this. Step 4, set it and forget it. This might actually be the hardest step because it goes against everything your emotions tell you to do. The biggest investing mistake beginners make is checking their portfolio every single day and panic selling when the market drops. I need you to hear this. Markets go down. They always have. They always will. But here's what history proves, without exception. The S&P 500 has had 11 drops of 30% or more since 1950. 11 major crashes, and it recovered from every single one. Not most of them. Every single one. And it didn't just recover, it went on to reach new all-time highs. Every single time. Your only job as an investor is to not sell during the dips. Do nothing. Hold. Let the market do what it has always done. The people who lose money are the ones who panic, the ones who check their phones every hour, see a red number, and sell everything at the bottom. Then they miss the recovery. Don't be that person. Turn off your stock notifications. Check your portfolio once a quarter if you must, but ideally, set it, forget it, and go live your life. The market rewards the patient and punishes the panicked. Now, let me give you 4 things to avoid completely. These are landmines. If you see them, walk the other way. Your future wealth depends on it. First, avoid individual stocks as a beginner. They are too risky. One bad earnings report, one scandal, and your investment can drop 50% overnight. You are not ready for that risk. Stick to index funds. Second, Avoid cryptocurrency as your primary investment. It's too volatile. It might have a place in a portfolio later, but it cannot be your foundation. Third, avoid financial advisors who charge 1% to 2% of your assets annually. That fee eats your returns. Over 30 years, that could cost you hundreds of thousands of dollars. You don't need them. Fourth, and this is critical, any investment promising guaranteed high returns is fraud. Guaranteed returns are illegal to promise. If someone promises them, run away. Individual stocks, crypto as a foundation, high fee advisors, guaranteed returns. Avoid all four, and you have already avoided the mistakes that destroy most beginner investors. You are now ahead of the game. Here is your action plan. Open your first investment account this week. It takes 15 minutes. You don't need $1,000 to start. Start with whatever you have. Even $50 invested consistently every single month beats $1,000 invested eventually. Consistency beats perfection. Every time. And when you open that account, drop a comment below. Tell me which country you are in. Tell me which account you chose. That moment of accountability matters. It makes it real. It makes it stick. If this video helped you, subscribe. Not for me, but for your future self. Every video we make is designed to move your financial life forward. Remember this, every wealthy person was once a beginner. They didn't start with special knowledge. They didn't start with millions. The only difference between them and everyone else is that they started. Today is your day to start. Not tomorrow, not next week, today. Open that account. Set up that automatic transfer and begin building the financial future you deserve. I'll see you in the comments.